Hello everybody, this is Chris Robbins from Grand Street Wealth Management, and today we're going to talk about choosing a proper benchmark. As always, you can go to grandstreetwm.com and click on blog to see all of our previous articles and videos. If you're unfamiliar with the book The Most Powerful Idea in the World by William Rosen, it's a pretty interesting account of the steam engine and all the things that had to happen in order for the steam engine to come about. One of the things I thought was interesting is that it wasn't until they developed a new way to measure the energy output of the early engines until that made inventors to be able to tweak their designs, and then they could actually tell whether or not these tweaks was actually creating an increase in energy output. Bill Gates has picked up on this whole idea of finding the right measurement tool as he tries to improve the human condition around the world. So if he's going to distribute, say, bed nets to people in Africa as a way to stop them from getting malaria, he really is trying to find the right way to measure whether or not those bed nets work. And if he can find the right measuring tool, he thinks he can solve the problem. So today we're going to talk about how to measure your investment performance, and so we can incorporate that into our decisions about our investments. The first thing you need to do when deciding what benchmark to use to measure your performance against is to get the geography right. So that means comparing US stocks to US stocks and emerging market stocks to emerging market stocks. This may seem obvious, but in one specific newsletter I'm thinking of that a lot of airline pilots that I know receive, they're comparing a portfolio of US stocks, international developed stocks, and emerging market stocks all together in one big portfolio, and then comparing that portfolio of stocks from around the world to the S&P 500. And as you can see here, here's a chart from the lost decade for stocks, they call it, from 2000 to 2009. And over that time period, the S&P 500 on an annualized basis returned negative 0.95% per year. Now, emerging market stocks, they didn't really have much of a lost decade at all. Over the same time period, even after the big drop-off in 2008 and 2009, emerging market stocks returned 10.11% per year. So, and especially in this time right here, when emerging market stocks just completely outperformed U.S. stocks, if you're holding a portfolio where you owned emerging market stocks during that time period and comparing it to the S&P 500, it's really not a fair comparison. So, step one, get the geography right. The next thing you have to make sure you have is that you're using a total return index as opposed to just the price change index. Now, if you watch CNBC or another financial television station for any amount of time, you're going to see quoted the S&P 500 index. And as I make this video the morning of September 18th, 2013, the S&P 500 stands at about 1700. Now that is the price change. Here's the ticker if you ever wanted to look up the S&P 500 on Yahoo Finance. It's GSPC, and this PC stands for price change. So this is only the change in the price of the stocks. It doesn't take into account the dividends being reinvested over time. To do that, you have to go, there's no way to do it on Yahoo, but if you go to Bloomberg and you type in this symbol, SPXT:IND, that'll give you the SP 500 total return, which this morning stands about 3,040. And that will tell you the total return, which takes into account reinvesting of dividends. And as you can see, if you don't include those dividends in your calculations, here's a chart of the S&P 500 from March 9th, 2009, the bottom of the market in the most recent financial crisis, up through the end of August of 2013. And if you didn't include dividends in your calculation, you would be down 24%. Now, the longer this goes on, the longer that those dividends don't compound in the calculation, and it's just going to get wider and wider over time. And the reason why they do this is because this number is so much easier to beat if you don't include dividends than this number where if you do. Which is why you'll never see this number quoted on TV and you'll always see the price change. So step two, make sure you're using a total return index. The third thing you need to keep in mind is that you want to incorporate style premiums into your equation. And we'll use an example to see what I mean by that. So let's look at this mutual fund PSOAX. Now PSOAX is a fund that invests in U.S. stocks, and the chart we're looking at is a total return chart. So that includes the dividends that came off of their investments. And we're compared that to the S&P 500, which is a U.S. stock index, and it's also that includes the total return. So that red line up there includes dividends being reinvested. Now this chart is from December of 1998 through August of 2013, the longest period I could find data for. And as you can see, this mutual fund definitely outperformed the S&P 500 over that time. And you could look at this chart and say, wow, that did very well. I want to invest my money in this mutual fund. It looks great. But if you compare it to a proper index, it might not look so good. So luckily, right in the name of the mutual fund, it tells us what we should use. So this is the JP Morgan Small Cap Value Fund. So that means that it invests in small companies that have some sort of value characteristics. So if we choose a more appropriate benchmark, in this case the Russell 2000 Value Index, suddenly the performance doesn't look quite as good, does it? So now that we have a proper index, you can see that, for most of the time, the two lines are pretty much right on top of each other, and at the end, the JP Morgan fund has a very small amount of outperformance. But as you can tell, choosing the right benchmark definitely puts the investment performance into perspective. Now, the mother daddy of them all when it comes to benchmarking is something called regression analysis. Regression analysis is a mathematical tool, and I won't get into the specifics of how the math works, but this is the output of a regression I did on the mutual fund PSOAX from December 1998 through August of 2013. And we'll just go through what these numbers mean, and then we can talk about why this is such a good tool. So let's look at these four columns first. So if you remember from our previous videos and blog posts about style premiums, here are the four style premiums we're going to use today. And this is the market premium, or the return of the entire stock market minus the return of the risk-free rate. Here's the small premium, or the return of small cap stocks minus the return of large cap stocks. Here's the value premium. Put small up here, small. Here's the value premium, or the return of value stocks. Here, high minus low is what this HML means. But this is the value premium. And here is the momentum premium. WML stands for winners minus losers. So what this means is that PSOAX gains exposure, or it gains about 93% of the market premium. PSOAX also gains about 44% of the small premium. It gains about 71% of the value premium, and it has exposure to a little bit about negative 9% of the momentum premium. So as you can see, we're not just gaining exposure to the overall market, we're also gaining exposure to additional premiums, namely the small and the value. And we're lucky in this case because the name of the fund already tells us that it's a small cap value fund, so we would expect to see these two numbers be somewhat high. And so after taking into account the exposure to these various style premiums, what this number over here, this alpha number, this tells us that after taking those four into account, how much extra performance did the manager provide to us? And in this case, not too much. They had an outperformance of 0.06% per month. But this T statistic down here implies that it wasn't statistically significant outperformance. So generally speaking, you have to have something greater than 2 in order to say something is statistically significant. So as you can see, these T statistics down here all are above 2, and in fact most of them are pretty high. So we can say with really good confidence that the numbers we're looking at here are somewhat correct. So we're pretty confident that it gains about 44% exposure to the small premium and about 93% of the exposure to the market premium. But we're not very confident in this small amount of alpha here. So what most people would look at this and say, well, it's pretty much no alpha. So there's pretty much no outperformance. So the fund manager provided no additional return to the fund that we could distinguish from zero. But we're pretty confident that he passively gained exposures to these other style premiums. The last number here, this adjusted R squared, what this number tells us is that after taking into account these four style premiums, these four style premiums can explain about 90% of the returns of this mutual fund. The other 10% of the returns come from the fund manager's own skill of picking whatever stocks in their universe they decide to pick from. But as we just saw from the alpha or the outperformance that the manager has, he didn't really do much for us. The last thing I want to do is just talk about how this can be a powerful tool when comparing two similar funds. So here in blue we have the Dimensional Fund Advisors US Small Cap Value Portfolio, or it's a mutual fund. And in red we have the same fund we've been looking at, the JP Morgan Small Cap Value Fund. Now both of these right there in the name say small cap value. So we could look at these, and if we weren't gonna go any farther, we could say, wow, two small cap value funds, the Dimensional Fund Advisors funds, look how much better it did. It must be a better fund. But by running a regression analysis, we can actually see whether or not that's true. So here's the regression we just looked at of PSOAX. So this is the one we've already looked at. Now let's look at the one for the Dimensional Fund Advisors Small Cap Value Fund. Now right off the bat, we can see that just as in the last example, the alpha or outperformance of the Dimensional Small Cap Value Fund was pretty much zero. 0.04% per month was with a t statistic of only 0.45. So we could pretty much say that there was no alpha derived from the Dimensional Fund Advisors fund. So how did it do so much better? Well, we can look to see what other exposure it had to other style premiums. So instead of only the 93% exposure to the market premium, it actually gained 100% exposure. Instead of only 44% of the style premium, it gained exposure to 83%. So we can tell just by looking at this regression analysis that, generally speaking, DFSVX, the Dimensional Small Cap Value Fund, owned and has owned a lot smaller stocks, gained more exposure to the size premium than the JP Morgan fund. The value premium, they both have pretty similar value tilts, and they both have pretty similar negative momentum tilts. And the last thing we can see is that the adjusted R squared, another way to look at this is to say that 97% of the fund's returns can be explained by these four factors. And that makes sense that it's higher because when Dimensional Fund Advisors builds their mutual funds, they actually try to passively gain exposure to these factors, in this case these three they're looking for, the market, size, and value. They're trying to passively gain exposure to these three when they design their portfolio. The JP Morgan fund, if you read their prospectus, they say that there's a fund manager who looks through the universe of stocks and picks stocks that they think will outperform and avoid the ones they think will underperform. So hopefully you've learned some tools that you can take with you as you try to measure your performance as if you're investing your own money, or if you're investing in a mutual fund, or you hire someone to invest your money. Hopefully you can be better equipped to judge the performance of the people you're hiring in the future. Well, that's it for this week, and we hope to talk to you again soon.